So it's fantastic to be here with you today on a Monday. For those of you who don't know me, my name is Juan. I am one of the co-founders of DarwinX. And DarwinX is a broker. I think the first broker that actually invests in its own traders. So one of my jobs is to figure out how to get the liquidity that allows you to trade against the market. And today I'll be hopefully clarifying some doubts for you as to what goes on from the point where you hit trade on your MT4, presumably, until that trade is cleared in the market. And there are different ways in which that can happen, and that's the core topic of today's webinar. We'll be talking about what differences there are as to when trades are cleared over the counter, which is what OTC stands for, versus on exchange, which is something which is very rare for FX traders, but I would argue should become more and more commonplace in the next couple of years, reading the way regulatory winds are blowing, and also just common sense and ethics, as we'll see in a second. I'd like to make this session as interactive as possible, so by all means you can type into the chat any questions you might have, and I'll try to tackle those there and then if I can, or I'll refer to later in the presentation if that's something that I plan to explain anyways. But either way, it's quite a lonely job to be speaking on my own, so if you feel like writing comments, by all means, I quite enjoy reading what you guys are thinking as I speak. So let's get going. The topics for today's webinar are how the Forex over-the-counter market works. And don't worry, it's not going to be a highly theoretical session. It's just going to be hands-on 5-minute discussion. Then we'll contrast that with how an organized market or an exchange or a central counterparty, which is a technical topic, how that works in other markets, and why we think that trading on exchange could become more and more commonplace going forward, and also why DarwinX sources its liquidity, amongst others, from LMAX exchange. So one thing I shall mention is that if you Google over-the-counter or OTC or central counterparty, CCP, there are plenty of online resources to learn what we're going to talk about. So hopefully you'll enjoy those when the time is right. So let's get going. What does it really mean when I say over-the-counter versus central counterparty? Well, let's focus on the left-hand side of this slide. Over-the-counter is how foreign exchange trading really started. So think of when you read A, this could be Goldman Sachs, B could be UBS, C could be Morgan Stanley, and then basically all the banks in the world, whenever they had a need to exchange currencies, they leveraged their existing network of relationships, and rather than exchange those currencies by an exchange, which we'll see in a second what that means, they basically had bilateral deals that were signed over the counter. That's what the OTC thing stands for. And basically UBS just said, hey, I need to sell $1 billion of dollars because I'm short of euros. Who wants to trade with me? And they would then engage in a bilateral transaction whereby somebody wired euros and dollars back, and that was that. Now, interestingly, the number of relationships there is pretty much exponential in the number of participants, because you can see there are n times n minus 1 cross relationships here. So Goldman Sachs here would have to have open dealings with F, E presumably, although I apologize, I should have had a line here which is missing, D and so on. And contrast that with the way an organized exchange works. And in an exchange, what happens is, rather than A speaking directly to, say, E, what A does, for instance, with stock trading, would be, if I want to buy some Apple shares, then I would just go to the relevant market and enter them into the order book as a limit order. And then if somebody had entered a limit order of opposite sign, then the centralized counterparty, which acts as the middleman between all parties, would basically match both, and a trade would take place. Now, sounds all very trivial, but as you can see here, the number of relationships here, this is a hub and spoke model, is a lot smaller because everybody is just dealing with the exchange. And there are a lot of interesting corollaries to this. So far, so good. By all means, any questions, I remind you, use the chat thing, and I'll be trying to take them. And if I know how to answer them, it'll be my pleasure. So let's get going. So I just grab this thing of Investopedia just to let you know how different assets are currently traded. So if you think of regulated markets, which is what I would call an exchange, you can see that obviously exchange-traded funds are traded on regulated markets. You have options and futures, which are, again, traded in regulated markets. Common shares used to be just traded in regulated markets, and then you could argue that the whole mess has started and people started creating dark pools and so on. So there's also over-the-counter trading for shares, even though it used to be on exchange. And there are other various instruments. If we move over to the right-hand side to over-the-counter markets, you see that typically bonds, which are typically more complex, and there are more types of bonds. They are more difficult to standardize. If you think of a share is a share. There's no shares with different maturities, whereas Apple might have 55 different issues of, well, Apple is a bad example because they're making so much money they don't need any debt, but there could be banks who, or even countries who issue tons of bond programs, each with, say, 30-year maturity. And then, of course, as you go along, then you have, 15, 20, 30 different bonds outstanding from, say, the Kingdom of Spain, which is very hard to put on an exchange because you need critical mass to standardize everything. Same goes for even money market products, where you have the shorter duration debt and so on. And interestingly, the question is, and this is a big question, how come Forex, which is really about the most liquid and standard plain vanilla asset class in the world, how come something which is so easily standardized isn't traded on exchange, but rather is traded over the counter, as if a lot euro-dollar was different from a lot euro-dollar, which is different from a lot euro-dollar. They're all the same. How come euro-dollar is not just listed as a futures contract, given it has leverage on an exchange? Well, there are reasons for that in the interbanking market, mainly to do with history. But I will argue that there are more reasons behind the history, and that is that in over-the-counter markets, if you're the clever guy, if you're the Goldman Sachs, and you get away with listing things on a bilateral basis, because you're typically smarter than the counterparty, or you have more means than the counterparty you're facing, it's in your interest to keep things over the counter, but it is not in the interest of the weaker party to the transaction to stay over the counter, because then they take a lot more risks. And those are the following. Well, actually, I just jumped ahead of myself. So if you guys don't know how an organized market works, I'll just do a 3-minute summary here on how order matching in an exchange works. What you have is you have the ask volume. So people who are on the ask, they will enter their limit prices on, and there will be software aggregating all those limit prices in descending order. So the further you get away, the further the price is from the, as you can see here, from the current market price. And then the market price really is the result at the top of book of where bid and ask meet. So at this point, the small differences between 44.60 and 44.66. This is just a screenshot of some share. I don't even know which one I picked it of. And what you have is people entering orders on the bid and on the ask all the time, both limit orders, which you can think of, stop losses and take profits, and also market orders, which would just try to hit the bid. So if I was going to ask for money at 44.60, I would just enter a market order and I would take this volume of 2,049 contracts outstanding. And if I was first to the order book, then the trade would be mine. Okay, and all this is happening because all the orders, and this is important, everyone's limit orders are put into a single order book. What does that have to offer to traders? Well, everybody is trading against everyone else, which is on the one hand tougher because there are no silly puppets in the market, but it's also fairer because it's first come, first served. If you're first to hit the order book, the trade is yours. Very importantly, it's anonymous. Nobody could reverse engineer who it is that they're trading against, because everybody is hiding behind the identity of the central counterparty. So what does this mean in practice? I'll just give you an example. So let's just take the world of poker, okay? If you were the world's best poker player, and you were just going to like some small time country and wanted to make a killing off the back of poker, would you like people to know that you're the world's best poker player? Come on, prizes, live account with our next funded for whoever answers here. Come on, here we go. No, there you go. So you wouldn't want that to know, because then people would perhaps not dare trade against you. That's the bad thing. Or even if you're looking at a market as big as this, they could do something even worse. They could just try to copy whatever it is you were doing to free ride of your skill. So you don't, if you're a good trader, you really don't want to know. So you don't want people to know what it is you're up to, because there's all sorts of bad things that happen when you do that. And that's, for instance, one of the reasons at DarwinX, where we offer what people think of as a copy trading service. But the last thing we will ever do is tell people what your live trades are, because if they knew them, they could copy them without a profit for you. So very important one. A CCP is an anonymous venue. And last but not least, this is a bit of a more complex technical issue, but the issue of counterparty risk, which we'll get into in a second. What it really means is if there is counterparty risk, counterparty risk is the risk that the other side on your trade defaults on its obligations. Put it another way, if you're making a killing on the Swiss franc, say some Alpari customers were doing on the day where the Swiss franc went 1 out against the euro, then the last thing you want is for the people taking the opposite side of your trade to go bust, because you're rich on paper, but you're actually just feeling like a moron, because the profits are just not there when you want to cash them out. So is this clear to everybody? Because the central counterparty is netting against everyone else, there is a very, very limited risk to anyone participant in the market, which is different from what happens when you're trading over the counter. So what happened to Alpari was that it had too many customers who were on the losing side of the Swiss franc trade, and they lost all their deposit they had with Alpari, and then some. They had what is now called a negative balance. And basically, so you had a couple of guys who had a couple of €1,000 accounts. Because Alpari was offering 500 to 1 leverage, those guys went then bust. So they lost the €2,000. And because the Alpari couldn't hedge itself in the time frame for like about 20 minutes from the euro going to 120 to parity with the Swiss franc, then the guys who lost more than their initial deposit, that ended up being Alpari's loss. And because there was no way for Alpari to go against the guys who owed them kind of 20, 30,000 bucks, Alpari went bust. Actually, I gave a webinar on this with FX Street. I think you can look it up. It's if you search for counterparty risk, I think I gave a full 1 hour explanation there. The important thing is when you are trading, the solvency of your broker or your dealer is a very, very important factor, because you really, really, really don't want to be winning money and then figuring out that it's just not there. So bottom line, it's not a coincidence that stocks and futures are traded on an exchange. And that's because there are a number of benefits that people tend to learn over time. However, because foreign exchange, particularly for retail customers, is such a young business, it's still taking quite some time for people to realize that, but eventually they will. And even if they don't, the regulators will. Right, so now we're zooming in on what matters to you guys, which is Forex trading for so-called, I hate the term, by the way, I hate the term retail traders. It means like you trade small because you just can't do any more. I prefer the term independent traders, where you trade for yourself because you don't want to be sucking up to anyone in a job. But unfortunately, in this slide, I was stupid and I didn't have a lot of place. So I put retail traders, even though I normally should have said independent traders. Anyway, that aside, let's look at how a typical Forex broker, which is not really in most cases a broker, it's typically a broker-dealer, operates. And bear in mind, the picture looks the same as for their on-exchange thing, but it's a completely different game that's going on here, and it has very bad things to it that I'll explain in a second, okay? So on the one hand, we have the market, which would be kind of the interbank players, Goldman Sachs, UBS, and whatever, exchanging currencies with each other at prices that are published by some software that aggregates them if they are published. And that results in a price feed that you can see in kind of Reuters, Bloomberg, and what have you. And then what you then have is really, think of it as a poker table, because that's really what it is. So there's a poker table here. There's a question on whether dealer cheat us by stop outs. I'll get to that in a second. Let's just continue with this one. What we've got here is a big poker table, which does not meet the criteria that you had on the exchange. So first thing, who's calling the shots here? Well, the broker-dealer is calling the shots because he's the one that sets the prices. So really, he's informed by what's going on in the marketplace, but down, if he wanted, all he needs to do is just kind of, he lists a price, which could be what Goldman Sachs and UBS are doing at that point, or it could be not, because it's his choice as to what prices he publishes. Now, this offers a lot of bad things that can be misused. I'm not saying all dealers do this, but potentially they could. The software would allow for that. They essentially can set one different price for every individual customer. What does that mean? Well, it could be that a dealer sees that a lot of people have, they're positioned a certain way on the stop outs, and yes, they could kind of change the price feed a bit to hunt those stops and essentially keep the customer losses. So they could do that, JP Nambiar. That's a sad thing, but they could be. The important thing here is that you really, 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 really don't want to be playing at a poker table where the house is also playing at the same time. So that's the issue, because the moment they set the prices, they control the rest of the process. Moreover, even if they don't kind of cheat in that way, they have a huge advantage, and that is as follows. They know for each customer how much leverage or margin they have left. They also know where the stop losses are placed, which is, as you were hinting, that's information that's available to them. And also, and more importantly, if they didn't want to manipulate the process in any way, they know their customers' track record. And I'll explain in a second how that can be leveraged. And either way, and this is the key thing here, they have much deeper pockets than the guys they're playing against. So they can stand, if one guy leverages 500 to 1 and multiplies an account of 1,000 to, say, 15,000 or 30,000 or 50,000 or 100,000 or even 1 million, that they're gambling basically by leveraging so much every time. That sooner or later, the chickens come home to roost and they're going to lose whatever they put down, and you're there to keep it. So really, it's a very tempting game to be playing. So what do many dealers do? Well, they create what I call the comfortable fishbowl. So if you want, I actually did a full explanation of this fishbowl analogy at the FX Street, and I think it's gone on to be, I wouldn't say viral, but I think it gets quite a bit of hits. But really what we're saying there is like, okay, well, why are we talking about the fishbowl? Well, because it's not the real market. The real market is here, and the only thing linking both is the price feed that is known to the broker-dealer, but not necessarily known to the individual customers, because you've only got your MT4 to check, okay? So, they create this fishbowl where you get a lot of leverage. You can leverage yourself 500 to 1, no problem. They can even offer kind of pretty low spreads, and as you'll see in a second, they could be artificially low. And of course, there's no slippage in the fishbowl because you want to be trading at the price you see advertised on MT4. So there's no possibility of slippage whereby somebody hits the market before you did, and you always get the price you wanted. Even at times when Goldman Sachs and UBS aren't really trading with each other, where the interbank market has stopped, like during non-farm payrolls. Darwin X, our spreads go a lot wider because there's no liquidity providers pricing into the market. And then we have people saying, hey, broker X or broker Y keeps the same spreads during non-farm payroll. Well, the moment you see that the spreads during non-farm payroll do not go up, you're dealing with a dealer, not a broker. because the market just doesn't work like that, right? So, however, there are a bunch of morons out there, as I'll say in a second, who think it's possible to make money. And sorry, for my bluntness, but if you think that you can multiply a 2,000 euro account into 1 million in 3 or 6 months, you're in for a rough surprise, because the thing that will happen is you'll very likely lose everything. And that's the thing. And there's a reason for that. And this one's going to be a bit complex. We'll talk into a bit of psychology, but it's really what's going on in the background. So there's something called loss aversion. To cut a long story short, loss aversion works as follows. It's a psychological bias that humans have, and that triggers when you are under stress, when you're kind of, say, pooing in your pants, kind of when the market is very close to your stop out and you could lose all your account, and you know that it's probably best that you enforce your stop loss, but then you go, Jesus, if I shut this trade down, then I'll lose most of my balance. So, let's just hope it's going to get a bit better. And then it doesn't, then you're out. Or even worse, in the opposite situation, when you are in a highly leveraged trade and you're winning, and then part of your brain starts telling you, hey, man, let's quit while you're up. So let's better close this trade now and lock in the profits. And this way, we keep the profits, which is nice and good. So can somebody tell me what's going on when that happens? What's your brain doing to you? Shall I give you a few hints? Have you ever heard of letting your losers run and cutting your winners short? I kind of told you right there. So what's going on there is, because you're under pressure, because you've taken more leverage than your gut can handle, then you're becoming loss averse, which means what I just said applied to traders. I'll give you an even better example, okay? Which is not related to trading, and perhaps it'll be clearer. So let's say you're sitting in court and you have a chance of being awarded damages. So somebody has done something nasty to you, and you have a very good chance that they pay you some compensation for it, okay? So let's say you have a very good chance, meaning you have a 95% probability of being paid 100 euros and a 5% probability of being paid nothing, okay? So you've got something which is de facto worth pretty much 95 bucks, because it's 100 bucks that are 95% certain. So what happens if I now come from the other party and make you an offer and say, hey, there's always the chance that you could lose, the 5% chance that you could lose. How about I give you 90 quid and we forget this whole thing? Would you? Yes? Okay. So would somebody not take it? We're talking about 100 quid, right? I mean, it's peanuts. You've gone to jail, so you've gone to court, and you're waiting for something which is pretty much done, and it's worth 95, and the guys are really only offering you 90. And I'm talking about like 90, like not a big amount. Would you guys still take it? I wouldn't take it, because the guy's he's taking the piss. I mean, he's offering me 90 for something which is worth 95. So I really wouldn't take it if I was acting rationally in this one. However, if instead of talking about $100, we were talking about $100 billion, I guarantee you that I would take it. So if I had a chance of making 95% chance of making 100 billion and a 5% chance of not making anything, and I told my wife that I was stupid enough not to accept a 90 billion offer, she would kill me and she would be right. And at that point, I would have become loss averse. So my answer. So I'll get back to that, JP. So my answer really depends on how much pressure I have. If I have no pressure whatsoever, I still act rational. If I have a lot of pressure, then I become irrational. So there's a question from JP Nambiar, which I think is very important. And he's saying, and I read, if everything is against us as designed by the broker-dealer, then should we ever trade? Can we genuinely make money? Can we seriously sustain a living through trading? And my answer is as follows. So first of all, you can choose to trade against a broker, with a broker, or against a broker-dealer. So for instance, Darwin X is a broker that trades with customers. We never trade against customers, so our incentives are squarely with you. And we're not the only broker out there. So I actually gave a webinar on how to find whether your broker is a broker-dealer, which I think is a rotten apple, or a true broker. So that's the first option you have. And then, should we ever trade? Can we generally make money? Well, we sure think you can. And we actually invest $2 million of our own capital to back our own customers. So we think there are guys in here who are genuinely worth of making a living as a trader. And what we do is we give them the capital so that they can make a living of their trading. So I sure think you can make a living. However, I sure think that by leveraging yourself 200 to 1, you will never make it. So my answer is yes, you can make a living, but no, you cannot by trading 5,000 euros. And the solution is, well, I don't know if there are any other offers out there, but for sure at DarwinX, we do just that. We give you the means to land investor capital so that you can make money on more than your own money. That's how we look at it. So do not be discouraged. It is possible to make a living. There are people who make a living, but the ones who think it's just, a short-term game where you can get rich overnight, those guys always lose everything. So as long as you don't do anything foolish, yes, you can make it. But if you do something foolish, then you'll be tempted into what I'm just describing here, and then for sure you'll lose. But it's your choice. It's not even the broker's fault, the broker-dealers. A lot of people just choose the broker-dealers as the boo man, and what they're doing is just lose it. Really, if you're not trading with too much leverage, then you're not getting there. So a lot of people asking me for details about my broker. It's called DarwinX. Just Google DarwinX and figure it out. I don't want this to be a promotion act for us. But for sure, do not give up. Just don't blame it on someone else, because it's right here. It's greed that could kill you. If you stay away from that, you're on the safe side. And eventually, if you persevere, you can make it. Right. So we were talking about the other issue, which is continuing with what broker-dealers do. There's a limit to what they do. Of course, it gives you a terrible reputation if you screw your customers. So, and also, if you have prices which are systematically off the market price, there's an arbitrage opportunity that you can employ. So scalpers and high-frequency traders, amongst others, try to make a living by trading against the poker table, because the poker table is trying to get the small fish over here, and you can be the smart guy who wins against them. So there's a question here as to what should be the minimum amount one should trade with in dollar amount. It really depends. I mean, if $1,000 is a lot to you, then it should be a lot less. If $1,000 is peanuts to you, then it should be more. It really depends on your personal circumstances. And I'm afraid I can't give you advice on that one. Anyway, the point, just to come back to the over-the-counter versus the on-exchange thing, what happens on over-the-counter is that there's the possibility of two FX markets opening up. One could be the so-called FX market where the broker-dealers are attracting people who haven't watched this webinar and still think they can make $1 million overnight by leveraging to the infinite and beyond. So those guys, they lose predictably because they are subject to this loss aversion. And because they lose guaranteed, it is very, very, very profitable to make markets by essentially betting against them, by inviting them into your casino, if need be, with very low spreads, without slippage and what have you. And that's what you do. Now, of course, at some point, those conditions will attract genuine winners, and those guys will start making money against the poker table. What happens then? Well, it is possible then to take, let's say B turns out to be a consistent winner. You really don't want to be booking against B because eventually, it's money that comes out of your pocket as a broker dealer. So what do you do with B? Well, unlike with poker, where there isn't an interbank poker market, with FX, there is an interbank poker market. What you do is send that guy to the so-called A book, which is then sent to trade against Goldman Sachs, UBS, and what have you, which is essentially what we at DarwinX do by default. So by default, we never trade against customers. We always act as a middleman that takes the other side of A's trade, like D's trade, and we send it then to the market. The snag there is, of course, that you might be developing an execution advisor here that seems to work fantastically well and makes a lot of money. and then one day you don't know what's changed, and then it stops making money. And I sure can tell you what's going on. Well, maybe all the algorithms have a limited shelf life, so eventually they stop winning. That's one option. The other one, and the more likely option, is that the dealer has noticed that you're making money off the back of them, and they have stopped taking the other side of your trade, and they're passing you the prices from the market. And at that point, you've discovered that your strategy no longer works when you're trading in the real market. So if you're thinking of making a living as a trader, you can't really make it by betting against a small-time dealer. You have to make it by trading against Goldman Sachs, which is the downside. It's a whole lot harder. The upside is if you're good at it, it's the best paid job in the world. So your call. It's always those are the options. We at DarwinX believe only in the A-book market. That's the only thing we do. We never trade against customers because we're looking for winners. So what would be the difference between the two markets? Will prices spreads differ? This is a very good question. So let's try and be systematic about it. So in general, average prices will not differ, except in certain occasions. So for instance, during non-farm payroll, on the real market, there's no liquidity whatsoever. So the spreads would widen a lot at those times, whereas in the subsidized market, where you're looking for gamblers who bet on non-farm payroll, the spreads would be artificially tight at that situation. So that's a situation where spreads would differ. Then another thing to tell whether a broker is a broker or a broker dealer, with a real broker, you should expect slippage. So slippage is actually counterintuitively, it's a good indication, which means that you're actually going against the real market. If you never suffer slippage, then you know you're trading with a broker-dealer. And again, the same issues apply. I guess that's... And then there would be things like small trade rejections and things that would make you suspicious. So it's not easy to tell. The easiest way to tell is actually, one is to check the spreads during major news releases. If they don't go out a lot, then you're likely not dealing with a broker. You're not in the real market. And also, from 9 to 9:05 London time every day, liquidity providers roll over their positions from one day to the next, and the spreads also widen. So if you don't see that the spreads widen from 9 to 9:05 London GMT every day, then again, likely you're talking about you're in a fishbowl. You're not in the real ocean. Does that answer your question, Saeed? So in general, they are the same thing, but there are points at which they are different, and then you need to know about those ones. Yeah. Then I had a question about. So there's a few questions here. Is FXCM a broker dealer? I wouldn't know. That's a question for them to answer. All I can say is that DarwinX is just a broker. And we've also provided the ways for you to know that. And also, what platform do we offer? We offer, amongst others, MetaTrader. So that was a couple of questions which were outstanding there. And then if you thought this was just something which I was making up, I'm just going to show you some the proof that there's some segmentation going on. So let me put it this way. If you can't, so one of the things that brokers, that dealers have is what's called the last look. So if you know that you're trading, that there's a position that has come in that is actually going to result in a pretty much guaranteed loss, you always have the possibility to give it a last look and pass on it and not close it, which is something that it's kind of reneging on a limit order, which is not allowed in an exchange. So there's a very interesting natural experiment, and it's called LMAX, which is to the best of my knowledge, one of the few true exchanges for Forex, and the source of our liquidity as a broker. And what we've seen there is a very interesting experiment. They used to have a single order book. There used to be a single LMAX where everybody traded against everyone else. And recently, they have resorted to having several sources of flow. So let me just show you a nice example. So there are, and these guys are the good guys, by the way. Don't get this wrong, right? So they source the spreads from the limit order book, and the spreads that you can get there. The top of book would be what you see on the screen here right now. Do you guys see something showing about 0.6 pips on the euro dollar. Can you guys confirm? Hello? Or is it not? Yeah, so showing that. Okay, so this is the spread that they offer on the so-called professional venue. It goes between 0.2 and 0.5 or 6. The question is, if you don't have last look here and you don't know who you're trading against, and there could be all sorts of winners in this flow, and if you provide liquidity to this, maybe you're not winning all the time. So to avoid that, what do you do? Well, whenever you see that there's too many guys who are winning, then you ask LMAX to remove those guys from the order book and send them instead to the alternative LMAX institutional order book, where you can see, do you guys see the spreads over here? And the market depth? Yeah. So any observations? Yeah, it's a lot wider. That's the first observation. And the second one, have you guys checked the market depth? Check one and check the other. It's a lot shallower pool, right? So you see that the retail flow. So LMAX they have had to resort to basically getting, whenever you have so-called healthy flow, it's a nice way of saying, if you send LPs a whole bunch of losers, then you get the 0.5 spreads. The moment you start sending too many winners, then, well, things change. And that's kind of the situation that you guys should get accustomed to. So because that's how the whole thing is set up. So at DarwinX, what we do is we try to basically route our execution through LMAX. We do not mark up the spread. So there's a question here from somebody saying, should people trade directly with LMAX rather than via DarwinX? That's an option. So if you're just looking for the execution, then you would be just as well with LMAX as with DarwinX, because we do not mark up the spreads and we charge the same as they do. So as a broker, we're comparable. It's the same thing. However, what we do offer, which LMAX cannot do, is a platform that diagnoses your trading with these grades that you have here. And if you do well, there's two things that will happen. So on the one hand, we prove that we believe in our traders by backing them with our own capital. So starting end of this month, we're going to allocate 20,000 euros of our own capital to each of the top 16 strategies that you've got here. And secondly, and more importantly, then you can become a tradable asset in your own right at the Darwin Exchange, which you can see here. So this could be, say, your own personal strategy. And I can assure you that if you make, say, 22% or 52% every year on this kind of risk level, then investors will want to back you and you will no longer have to take too much leverage. So I think with the right business model, and we really are trying very hard to provide the right business model, it is to make a living here. And that would be another reason to go to DarwinX instead of going to LMAX directly. But obviously LMAX are, out of the ones we know out there, that's why we source our liquidity from them, because they are very good. We think they are the most honest out there. So if you come to DarwinX, the setup we've got is, on the one hand, we aggregate the flow from the LMAX exchange plus a number of liquidity providers via another prime broker. So what we're trying to offer you is the best of both worlds. If there's somebody willing to take the other side of your trade and it's a tighter spread than you get on the LMAX exchange, then we try to offer it to you, but as a last resort. Then so there's a question here, but the spread is same. So as last resort, you can always talk with someone else. So there's a question here, which is the spread the same for DarwinX or with LMAX? So the spread is the better of LMAX or what we can source elsewhere. So worst case, you would be left with the LMAX spread. That's how we set up. Okay? But essentially, that's what we're trying to do here. So we have, what we're doing is essentially we are a broker. We will never profit from customer losses because we're a pure broker. And then in addition to that, what we do is try to turn your strategy into an investable asset such that investors can buy it. And because we believe our own talk, we buy it ourselves by putting 20,000 euros of our own bucks. So your call. But ultimately, if I were to summarize, as I said, I'll come back to my comment from before. There's a reason why stocks and futures are not traded off exchange. And hopefully those are the reasons that I described. It's because it's not anonymous. because it's because everybody's trading against everyone. There's one price which is the same for everybody. It's anonymous and it minimizes counterparty risk. And I very strongly suspect, having been in the industry for the last 15 to 20 years, that eventually regulators will force over-the-counter retail forex trading on exchange. So we are there. And then there's a question here, does DarwinX offer indices like LMAX? And I'm glad you asked that, Manoy. We will start offering indices from next week or thereafter directly from LMAX, because we're also moving to our own MT4 offering. So the answer is in 2 weeks. Today we don't, but in two weeks' time, we will start offering LMAX indices. And it will be the exact same indices, yeah. So a question on what is the best trading strategy indicators in my experience. So I am not a trader. I don't have what it takes to be a good trader. So I could not give you any advice on that, I'm afraid. And even if I was a good trader, what would be my incentive to give you my secret recipe? That's if people are not charging you and they're giving you advice, do not trust people who give you free advice. That tends to be serving their interests, not yours. Any more questions, guys? Because as usual, I think I've run over time. Okay, so it looks like we're doing good. All right, well, so if you guys are interested in this kind of stuff, we have a Google, a YouTube channel where we explain this and many other things in our channel, including how to tell a broker from a dealer, or how to understand the incentives of a broker and a dealer. You can also follow us at the Darwin Exchange on Twitter. Or you can even just go to DarwinX, to Google DarwinX webinars, and there you'll see the webinars we provide to our own users. Registering to our site is completely free, and we will never bullshit you with bollocks advertising, and we will certainly never, ever, ever sell your email address to anybody, because your confidence is the only thing that matters to us. So if you're curious, go for it. And otherwise, thank you so much. It's always my pleasure to speak to you guys. If you have any questions, by all means, I'm just going to put my email address here. So you can email info@darwinx.com, and people will be, my support team will be hopefully guiding you to more interesting answers. So thank you so much, and best wishes, everybody.